Welcome to Subramani. I'm going to talk to you about some more axioms in the market and tell you that does not mean that you will make money in the market. So let us take the first one, which all of us have heard, whether it is Buffett or Peter Lynch or John Templeton, all three Americans have said in the past is in the long run you will markets equity will do well. I agree with that. In the long run, equity will do well. But remember, you could be invested in Taiwan and China could do well. You could be invested in Japan and China could do well. You could be invested in India and US could do well. All of that, which means in the long run, market equity is making money, but you may not be in that particular market. That can happen. You may be invested in mid caps and large caps could do well, right? So you should worry about markets only when you are in the markets exactly like the market. For example, people ask where is the Sensex or where is the Nifty today. It doesn't really matter because most portfolios do not reflect the market. You just picked up some random shares which could do better than the index, maybe worse than the index. Your portfolio could do anything. But remember, all these axioms saying in the long run equities will do well is right. But that does not mean in the long run in equities you will make money unless you have built a good portfolio of good companies and waited in the long run, and you are not going to be concerned too much about whether French markets are doing well or whether US markets are doing well. You have invested in Indian markets, maybe in the index, maybe some large caps, some mid caps, some flexi cap kind of a fund. You have to be clear whether that fund is doing well in the period of time that you are invested. So over 5 years, 10 years, 20 years, 50 years, the company, the places which you have invested, the country in which you have invested could make money. But if your time frame is 1 year, 2 year, 3 year, 4 years, you may not have made money, right? So understand that it's very important to know that equities will make money in the long run. But when we say equities, we mean the world markets, right? Not just one market. For example, for whatever reasons, if the American president decides, of course he will not be allowed to, that arms are not a great way to improve the world, then the American GDP could take a hit because a huge part of the American GDP is made out of arms and ammunition, right? So you have to be clear that in the long run, equity markets will make money is something which most American scholars have said, right? Or you have not heard a Russian saying, oh, I invested in the Russian market in 1908 and in 1917 the markets closed down. It just shut down. Then what happens, right? So the only assets that you have is financial assets, and financial markets close down. What happens? We don't have an answer to that, but it has happened in the past. So you have to be worried about such things which can happen. So yes, equity does well in the long run, but it does not mean you will make money in that market because you are not in that particular market. In the short run, you could get completely killed by what is happening in the market simply because your reading of the market for the short run may be wrong, and the markets could decide something differently. For example, in 2024, if you had decided that you will be bullish, but if the results, election results in India and US and all are very different from what the market is predicting, the market to take a hit. So it might take 2 years for the market to recover, but then in the short run, you are going to be just smoked out of the market, and that could really hurt. So in the short run, markets could do whatever it wants. You could wipe out 50% of your net worth. It shouldn't matter, because if you know that in the long run it is going to make money, you have to have other sources of income. You have to have maybe dependent on dividend income, salary income, rental income, something which should not bother you too much about the fact that a portion of your equity portfolio has been wiped out. So if you are a person who is very scared of putting money in equities, then be careful, don't put too much. Some of us would have 90% in equities, knowing fully well once in a lifetime we may lose 50% of of our portfolio, but does not bother us, right? So that's important for you to know that in the short run you could get smoked out and you could get hurt really bad. And another thing is, what is the average return to expect? I do not know why, but most people answer this question as 12 to 15%. It's not your right to get 12 to 15%. I don't know from where you get that number. And also, this 12 to 15% is not a PPF kind of a return that 7 to 7.25 is where it will fluctuate. No, 12 to 15% may be possible over 5 years, 10 years, 20 years. I'm not even getting into the numbers, but that 12 will not mean 12 to 15. 1 year you will get 32%, next year you will get 0%. Right, so you will still fall within the range even for 2 years, but you will definitely fall within the range only for 10 or 15 years, and after that, if you don't fall in that range, then the range changes. You cannot argue with the facts that this is the return that you have got. What about wiping out 50% of your equity portfolio? Not impossible, but pretty unlikely today, because all over the world, the Fed or the RBI or the government of India, nobody wants to see such a long and deep fall, right? So they will do something to protect, so don't worry too much about that portion, right? So, but one thing is, you will never get anything between, let's say if it is 14% is the average which you are expecting, expect 0, expect 28, expect 32, except -3. These are the numbers which you are going to see in the long run. The average 14, you will never see it, right? But the average could be 14. So remember that if you plot these returns of equity on a chart, it's going to be very confusing. So don't expect there to get 14 ever, but average could be 14, or average could be 12, average could be 9. I'm not saying how much the average would be. I'm just saying that the numbers would fluctuate dramatically in your total return. Another thing which people have to understand and accept is, when I take my, say, 40-year investment journey, all my returns could have come from 10-12 companies, and the other companies would have just been a drag on the portfolio. It could come from one geography. All the companies which could be headquartered in Bombay, or in my case it is headquartered in Bombay, Chennai, Bangalore. That's it. I have not made money from companies in Delhi, and here I exclude MNCs, because an MNC like ITC could be located in Calcutta, an MNC like Nestle could be located in Delhi. It doesn't really matter. MNCs don't have too much of a choice. I don't think ITC can shift out of Calcutta so easily, right? Politically not possible. So other than that, when it is Indian promoters, I have got an extreme bias towards Mumbai, Bangalore and Chennai. I don't look very favorably with companies from, say, even Ahmedabad or Delhi or Hyderabad. Hyderabad is a complete no-no. So what happens when you look at your portfolio, you realize that, oh, you've invested in about 100 companies, you got out of them, so you're stuck with, or you now hold 30-40 companies, maybe 60 companies, but all your returns have come from 10-15 companies over the years. This is very scary. And also over 40 years, that would be some 5 years, and you made a sensational return. In 6-7 years, you made good returns, and in some 15 years, you made bad returns. So on an average, you have outperformed the index. That's good. So that is how you look at it. Don't say every year on year I should get, and companies from Bombay and companies from Chennai and companies from Delhi is a good diversification. All that may be true, but all your returns could be concentrated in over periods of time from groups, from certain, all your money could have been made from IT companies for a period of time, from some other, from automobiles for last 1 year. Automobiles have been on a fantastic run, right? So all these kind of things could happen. So don't expect anything called average. On an average, what will happen? On an average does not make any sense, because the standard deviation is too high. So the asymmetric upside on parts of the portfolio is a fact. Accept that as a fact, right? So some of the basics: earnings drive stock prices. You cannot deny that. If there is good earning, there will be good stock prices. I'll continue it in the next one. Thank you. Welcome to Subramani. Continuing the valuations and axioms on stock markets. One, valuations don't tell you anything about what the market is going to do next year, right? It is a question of relatively you may do better. That doesn't mean you will do well. If the whole market is up by 2% and you're up by 2.25%, technically your that particular share has done better than the market, but that doesn't mean anything. So you don't need valuation, quality of management, market share. None of this ever prepares you for what is going to happen in the next year. So if you are in year 1, what is going to happen year 2, valuations don't tell you that story. Valuations can't even understand that story. That story is useful only if you are in the long run. For example, whether it is Zomato, whether it is Indigo, valuations would have told you nothing in 2019. Nothing would have prepared you for the pandemic, right? You never expected a share price to fall from 2000 to 800, and then now perhaps it's at 3500, right? That kind of change, the valuation couldn't have said. What is going to happen in the market, nobody knows. The biggest risk in the market is that risk which nobody can see, right? In January 2020 and perhaps even in February 2020, we were worried about inflation, we were worried about US, etc., etc. In March 2020, something called COVID happened, and then for the next year or two, we spoke about nothing except COVID, recovery, what will happen to the markets, etc., 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 right? So that is what happens in the market. You always are worried about something. There will always be something to worry about. Oh, what happens if BJP does not win? We worried about that in 2019. We'll worry about it in 2024. We'll worry about it in 2029. We will constantly have something to worry about. What happens to US elections? Oh, will Pakistan break up? Is China a good market to invest? What about China soft landing? Are the Chinese numbers good or are they unbelievable, right? All these things, something will always be there to worry. Ukraine-Russia war was something to worry about maybe in 2021, 22, but whole of 23 passed. Now we are in 24. The war is nowhere near ending, right? So are we worried about it? No, we have accepted that Ukraine war will be like this. The world will have a food grain shortage. There will be demand for Indian wheat. All these things we have now accepted. So some good, some bad will always fall out of every war or every action in the world. We will learn to live with it. But is there something to worry about? Permanently there will be something, and you will also find that should I be investing in China? Should I be investing in Japan, or is it too late? Should I be investing in US, or is Taiwan still good? Oh, what about great yield shares in Korea? There will always be opportunities. There is always going to be something to worry about. You have to decide that I will ignore them currently and then keep investing, right? So there is a Tamil saying which says it's like entering the market where there is no risk is like trying to take a dip in the ocean after the waves have stopped, right? It's never going to happen. So valuations in the short run mean nothing. There will always be something to worry about, and the risks are the ones which we are talking about which we know nothing. There will always be a lot of turnover in the market. So whenever you go to buy some share, you see the volumes, you'll be stunned by it. But then remember, like every market, there are many more players who are buying and selling than people taking delivery, right? So it could be some 95% of it is speculation, 5% could be delivery. Suddenly when that 5% becomes 10%, share prices could go up. So looking at these numbers is important, but it doesn't tell you anything. The turnover does not tell you anything about whether the company is good or bad. It just means that more and more speculators, more and more day traders are now investing, removing, selling, trading something in the share. So the activity level has gone up. It just doesn't mean anything. It just means one good thing for big shareholders. Liquidity will be faster. So 1 crore shares, earlier you may have been taking a week to sell. Now you may be able to sell in a day. So when you have that kind of volumes develop, a lot of people will come. But that doesn't mean anything for you as an investor, right? So is the share market the economy or is it not the economy? Both ways you are right. So sometimes you feel that a lot of companies which are there in the market, which are listed, obviously are playing a role in the Indian economy. But the role of listed companies in the Indian economy could be very small, right? So your local kirana wala is not covered in it, your local restaurant is not covered in it. Many of the products which you use are not listed. If you're using a Samsung phone or an LG fridge or an LG washing machine, none of that is being captured, right? So your Hyundai car is not being captured, your Honda City is not being captured in the index. Yes, your Tata Motors and Maruti are being captured, but a lot of cars which are sold do not belong to the Maruti and the Tata labels, right? So that is not being captured. Your eating out is not captured, McDonald's is not captured, Starbucks is not captured, Starbucks is captured, Tata Coffee, right? Or is it Tata Global? I'm not very sure. Please check your facts before you take any action. So a lot of it is not captured. So remember that also, that economy, it doesn't mean it is the economy, it doesn't mean it is not the economy. It's both these statements. The stock market is not the economy is true, and the stock market is the economy is also true, right? So why am I creating these videos about what is happening in the stock market or what could happen in the stock market? Is because I create very many videos saying I have no clue where the market is headed in the next few years, right? But I know these things about the share market, that yes, my portfolio returns could be outsized a few years, could come from different geographies, could come from one geography in a very concentrated way. It doesn't mean anything. It does not mean if I get a company from Chennai, I will invest or I will not invest, right? So for me, the place filter becomes easy because I am not looking to buy new shares anymore. I have enough good quality shares. Just taking care of that is good enough for me. So I'm making these videos just to tell you that the market, there are a lot of unpredictable things, but a lot of things which you should know. You should know something is unpredictable, right? So that is also being prepared for some unpredictable events happening. If you don't do all that, I mean, expect to lose 50% of your portfolio once in your lifetime. Expect to see 30% drawdowns 7-8 times in your 30-40 year investing horizon, right? Or maybe 70 years investing. You started investing at 20 and you died at 90. Yes, there will be 70 years. So in 70 years, you will see maybe 2 times drawdown of 40%. You may not see a 50% drawdown at all. You will see regular 30% drawdowns, 10% drawdowns, right? All these things you will regularly see. Keeping yourself prepared for such events is what I hope my videos do. Don't ask me tomorrow what to do. Should I buy Paytm? Right? This is not the place to find those answers. There are enough videos available, enough YouTube channels available on a day-to-day movement of the market. I don't understand day-to-day movement of the market, so it doesn't matter to me. So I don't watch that, so I can't even comment about it. Thank you.